Hey family, it is your girl Yolanda coming to you with another video. I am a realtor with Virtual Properties Realty. I am a member of the Sweet Home Solutions team. I am also a lender or a loan officer with Southeast Mortgage. They are both here in the Atlanta area. And today's video is going to be about how we qualify you for a loan or a mortgage. And it's just gonna be a quick video. I'll do another video later on if you want to know like a little bit more about the things that I talk about. But the big things that we need to know if a buyer, you, or if you're a realtor and you want to know, what really do you need to qualify for a loan? These are the things that we look for. So the first thing is your credit. Yes, we have to pull your credit in order to qualify you for a loan. And we have to pull from 3 bureaus, and we use the mid score. So if you have a 600, 650, and a 700, your mid score is 650. And the things that we're looking for on your credit report are your payment patterns, your credit utilization, your payment history, how many lines of credit that you have. When I say lines of credit, I mean like, do you have credit? Sometimes when you're straight out of college, you don't have any credit and you don't have a score. Like sometimes a score doesn't even report. So in those cases, we would give you some things that you can do to have certain things start reporting to your credit. When we talk about utilization, if you have $1,000 credit limit and your balance is $900, that's high utilization. You only have $100 left. So if you had a lot of credit lines that were like that, we would advise you to pay some of your credit down if you didn't qualify. And of course, late payments. We don't want to have a bunch of things that are in collections or a bunch of late payments that are reporting. Those are the things that we look for in your credit report, and that can cause you to not get approved for a loan. The second thing that we look for is capacity. When we talk about capacity, we're talking about, we call them debt to income ratios, and that's pretty much your ability to repay the loan. So we look at your housing expense, and your housing expense is your housing expense divided by your gross monthly income. We call it the front end ratio. So that's your monthly payment plus your taxes and insurance divided by your gross monthly income. The second thing that we look at is your total debt ratio. So that's everything. So that's your housing expense, your car payments, your credit cards, your loans, and we take all of that divided by your gross monthly income, and we call that your back end ratio. So you have a front end and a back end, and different programs require different ratios. So typically we want your front end to be about it just depends, 40, your back end if you're doing FHA 57, but I mean, I'm very conservative. I want to have some wiggle room, so I start slowing up when we get to 50, but that's another story for another day. But capacity, do you have enough income against your debt that's coming out of your income every month to hold up a mortgage payment? Do you have the ability to even pay? Like, to me, that's almost more important than your credit score. You can have a 700 credit score, but if you don't have enough income coming in to pay your debts, you will not qualify. So remember, you need to be thinking about how much debt that you have when you are trying to get into a loan to buy a house, because your debt to income ratio will kill a deal. Cash. Do you got money in the bank? When we talk about cash, the things that we need to verify, we will ask for your bank statements or your, Social Security award letter. If you get child support, we'll want that documentation to see how much cash you have coming in. And you need money for down payment. First and foremost, you will need money for your earnest money payment. That's going to vary based on what you agree to in the contract. You're going to need money for a home inspection. I do always recommend as a realtor that you get a home inspection. And you will need money for an appraisal. If you are getting a mortgage, your lender will order an appraisal. The difference between an inspection, the inspection looks to make sure that there's nothing seriously wrong with the house, so the house works. The appraisal is an estimate, like it tells you the value of the home. So the lender comes out and says, yes, this home is worth such and such amount. So you do have to pay for your appraisal. Then you also have to pay for closing costs. Closing costs are also going to vary, and it's going to vary based upon lender to lender. Certain lenders have certain fees, but generally it's pretty much the same fees: title fees, appraisal fees, origination fees if you're paying for a lower interest rate. All that stuff is jumbled into what we call closing costs. And the seller can contribute to closing costs, but they cannot contribute to your down payment. So if you're in a buyer's market, kind of like how we are right now, a lot of sellers are giving money towards closing costs, and that can help with your cash needed to close. So when we talk about cash to close, we're talking about your down payment plus your prepaids, like your upfront taxes and escrow payments and all the fees for the lender. All that jumbled up together is your cash close. Down payment, prepaids, closing costs, cash close. You got to have that in the bank, okay? And then your income. Yes, you have to have consistent income. Typically, we want to know 2 years of work history. If you've been at your job for 2 years, great. If you've been at your job for 6 months, we want to know where you've been working before. Hopefully it was somewhere else very stable, because the underwriter is looking for stable work history. If you jump around from job to job to job, it just makes you less risky if you have strong work history. We look for if you're full-time, if you're part-time, if you're self-employed. And again, we look for about 2 years of work history. Your income, of course, lets us know how much money you're bringing into the household. If you don't have a lot of income, you can always get a co-borrower. If you have a spouse, of course, we can put both of you on the loan. That increases your income into the household, which allows you to buy more home. Do not be afraid to have a co-borrower, because your co-borrower helps you get more home. And especially in this market where houses are kind of expensive, the value of homes are not dropping. So, sometimes you by yourself may only qualify for $150,000, and you can't find a home that you like that's worth $150,000. So you need more income. Think about, getting a co-borrower. Sometimes we can even do a non-occupying co-borrower. So somebody who's not living in the house, but they are going to be on the mortgage with you. There are options out there. But those are the big things that we look for, or that we evaluate when we try to get you qualified for your mortgage. So as a realtor, it's important, definitely want to ask them their credit score, but you want to ask them, do you have debts? Do you have a car payment? Do you have a lot of student loans? Are you late on any government-backed loans? Are you late on any student loans? You have stuff in collections. Do you have cash? Roughly how much cash do you have in your bank accounts? All of them, savings, checkings, 401ks, and just kind of get an idea of where your borrower stands. And definitely, have you been on your job for 2 years? Are you full-time? Are you part-time? Do you have any other sources of income? Any self-employment, any side businesses, any side hustles that you report to your taxes? Because trust me, the underwriter is going to be looking to see all the income that's coming in from your bank statements. And if they see like your sneaker business paying you every month, but we don't have a W-2, they're gonna want your tax returns, and they're gonna want to see if you have negative income. I know sometimes when we file our taxes, we write a lot of things off as negative income so we can get a return. Got to be careful when you're buying a house, when you're doing stuff like that. But again, a good lender and a good realtor can guide you through all of that to make sure that you are on the right path. I know that was a lot of stuff, but I hope that it kind of makes sense as to what we are going to need, what we're going to be looking for. In my next video, I guess we can talk about what documents we look for to get all that information. And that'll be my next video. So stay tuned for that. But remember, we need to know your cash. We need to know your income. We need to know your credit, and we need to know your capacity. Are you able to pay the loan? I will talk to you guys soon, and I hope that you all have a great day. If you're looking to buy or sell a home, I'm a realtor. If you need a loan, if you need to get qualified for a mortgage, I am also a lender here in Georgia. And I look forward to working with you. Any new realtors and you have questions or you need help, I'm here to help. I want to help all my realtors be the best that you can be. So ask me anything. I'm here to help. And I will see you guys next time. Bye.